Hey guys, thanks for watching. In this video, I'm going to describe how to use derivatives using Bybit as an example. Of course you can use other exchanges, but I just use Bybit, so I'll use that one. And in this video, I'm going to go through the ins and outs of how to trade derivatives, and not like a noob, common mistakes, and I'm going to work through Bybit as an example. I also put timestamps in this video because I go through a full A to Z pretty much tutorial of Bybit and derivatives in this video, so you might find that certain things you already know, but there's certain, for example, more advanced concepts that you might not have already known. So whenever you drive, you don't really need to know all the fine details, like the exact mechanics of a car. You just need to know how to get from A to B, just the main principles. And this is my approach to derivatives as well. The first question people ask is, how long should I use a demo account for? And the answer is there's no set time. Personally, I used a demo account for a couple of weeks, months, and then after that, once I got more comfortable with it, I then set up a Bybit TESTNET account. And how do you set up a Bybit TESTNET account? So the first thing you do is you sign up. You just type in BYBIT and you literally just sign up. And the main thing is to check this fine detail here. It should say testnet.bybit.com. And this account is a testnet account. I've actually loaded up 28k of paper money, and the way you do that is you click the chat box and you type in request test deposit, and they let you deposit how much ever money you stated. The main thing is to check the top. It should say testnet.bybit.com. And please guys, for flip's sake, do not deposit real crypto into the testnet account, because you will lose the money because it's a paper account. I know that some people are told that they have to do demo account for several months and in some cases several years, but personally I just honestly think a couple of weeks to a month to really familiarize yourself with how to use the Bybit testnet and just derivatives in general, and then perhaps open a small account. So in my case, I opened a very small account of like $100. It's money that you should feel that if you lost, it would not be the end of the world and it would not significantly affect your lifestyle. But at the same time, you need to feel the emotions of going through the trade. The hard-earned lessons that you actually learn while making mistakes on a paper account is not the same as the ones you learn with real money, because trading psychology is an important aspect of trading. So I just picked Bybit because I generally like an exchange with good liquidity, and as we've realized from the FTX crisis is that we need to look for exchanges that actually show proof of reserves, but also we need to see the liabilities as well. So that's important. Do as much research as you can. And I like Bybit also because the spread between the buying and selling is not that bad as well. If you're interested in signing up to Bybit, there is a referral link in my description below, and you get thousands of dollars just for signing up. It's interesting also from the FTX scandal is that risk management is not just about risking a certain amount of your portfolio, but it's also about not putting all your funds in one exchange. And that's why I always recommend don't just put all your funds in one exchange. For example, Bybit, perhaps spread it around with some different exchanges, and actually diversifying your funds across several exchanges is another form of risk management. So in terms of VPN, it really depends where you're living. I'm in the UK, so I just use Surfshark. And there is a link in the description for a referral link if you're interested. But in some places, especially US, people have difficulty signing up to Bybit. And so you can use a VPN like NordVPN or Surfshark. I'm aware that there are other exchanges like, for example, BitGet, but I'm still doing research on that, a couple of months research. I am trying to look into BitGet as well. And when you open the account, the first thing is that you need to often transfer money in your real Bybit account, and so the way you do that, you need to put the money into the spot account, and then you have to transfer it to the derivatives account. And the way you get to the spot account is you click assets and you click spot here, and you just literally transfer it to the derivatives account. It's very self-explanatory. There's also a transfer button here as well to just navigate yourself. Of course, there's a Bybit chart, but I don't personally use this chart. I prefer the TradingView chart, mainly because the TradingView chart in the Pro Plus plan, which I like, has a lot more functionality. But some people do use this, and it does have basic functions. As you can see, there's a dashboard here. This shows the price of Bitcoin, the 24-hour change, 24-hour high, and 24-hour low, and the turnover, 24-hour turnover. But this is the aspect, this funding rate, which catches a lot of people out. A lot of people do not actually understand what funding rate is. And this updates every 8 hours. And in this case, it's positive now. A positive funding rate means that speculators are bullish. So in other words, people who are opening long positions are paying a premium to people who are opening short positions. If the funding rate was negative, that means that speculators are bearish. So people who are opening short positions are paying a premium to people who are opening long positions. You need to understand that derivatives is different to normal spot trading because you're not actually trading the physical asset. In some ways, it's kind of like trading a CFD. You're trading a derivative, and so the price is greatly determined between the actions of long people and people going short. And as I mentioned before, this updates every 8 hours. This is the order book, which shows real time the depth of the market between buyers and sellers. But please bear in mind, this is the order book of specifically Bybit, not all the order books of all exchanges combined. And you also have to realize that order books and order flow has its own weaknesses. For example, whales sometimes place big orders just to scare off retail. So every indicator has to be used in confluence with your own analysis, and you cannot rely purely based on one indicators. I mean, of course, there are traders that purely trade based on order books. But the main thing is you learn how to use all these functions mostly by doing and practicing. And just having a play around with it, really. This section shows you how to actually place an order. And in this case, this shows isolated. So you click on this and you can have isolated mode or cross mode. Personally, I recommend isolated mode. You can actually have a read about the different modes here in the section below. Why I like isolated is because it's significantly safer. Say you're putting up margin for a position. In isolated mode, that if you get stopped or if you get liquidated, only that particular margin you put up for that single trade gets lost. But if you put cross mode, then even if you exceed your margin put for the trade, your actual account balance on the overall account will actually be eaten into. So even if you got a losing trade, your whole account can get completely wiped out because you're opening up your whole account as collateral. For most people, honestly, I recommend isolated, and I just use isolated. This shows leverage. So this is, you can adjust the leverage as well. So you can use 10x, 25x, 5x. And you can do it for the short section as well. Personally, I only recommend 5 to 10x, but it all depends on the person. And the thing is, leverage is a tool. Leverage is a tool that can be used to either amplify your account or wipe out your account quicker than you could say FTX. For me personally, leverage is just a safety mechanism in the sense that, say for example, someone has a 100k account. They don't have to put the whole 100k into the actual exchange. They can perhaps put 10k into the exchange for safety mechanisms. For example, if the exchange goes bankrupt and if there's something wrong with the exchange. So for me, it's just leverage, in my definition, is just a tool to put less margin into the actual account for a trade to meet the position size requirement for the trade without having to put all the capital up front. I personally don't know any trader that have got rich consistently just using high leverage. So I thought I'll open up a trade today just to show an example of how to actually trade and just to walk through certain principles. So I have put a link in this description below for this crypto position size calculator. You don't actually need it because Bybit does do a lot of stuff for you, but I'm going to walk through this for an example of a trade that I opened up in the past and just to highlight some concepts. So in this case, pretend I'm short selling and this is a 100k account, and whilst price has changed, at the time I entered a short position at 16,650. My stop loss was at 16,850 and I risked 1% of this 100k account. I've just used 100k as an example because it's an easy number to work with. So as you can see, this is my position size, so 5 Bitcoin for this criteria. But that's before using leverage. So in this case, to meet these requirements of the trade, I need to have 5 Bitcoin. But with 10x leverage, I only need 0.5 Bitcoin. With 5x leverage, I need 1 Bitcoin. So as you can see, with using leverage just means that you're able to put less margin needed to put the position size. Just play around with this calculator if you are interested, and it will just really highlight the concepts to you. A lot of this stuff you learn by doing, not by theory. So one thing I like about Bybit in particular is that it has this risk management calculator, and it just really helps to highlight the main concepts to you. So in this case, you click this calculator here. So let's use the example of this trade to open up a trade on Bybit to highlight certain key principles. So using this risk management table, I've put here 16,650 because that was a short I entered, which turned out quite well. Then 16,850 as the stop loss, so close price. Say quantity here is 2. As you can see, if I did this trade with the leverage of 1, my actual loss will be minus 400. So in the case of this demo paper account, I have $28,116. So what I generally like to only risk 1% of my portfolio per trade. And even this risk management calculator, they actually recommend at the most 1 to 3% per trade. I only risk 1% because it means that it will take me 100 attempts to blow up the account, which obviously is not my goal to blow up the account, but it just means that I can stand the test of time, and it allows my edge in trading to catch up and to compensate for any losses. I'm only trying to play really high probability risk reward setups. So in this case, this is too much risk for me, because if I lost this trade, I would lose $400, and this is more than 1% of my account. So I'm going to keep adjusting this number until this becomes 1%. So if I put 1.5, it's 300. Okay, so still a bit more. So plus 1.4, 280. Okay, so this is fine because my account value is 28,116, and if I lost this trade, I lose $280, and $280 is 1% of 28k. If I put 1x leverage in this scenario, as you can see, I would need a margin of 23,310. So that's like a significant amount of my account, right? But if I increase the leverage to 5x, as you can see, nothing has really changed here. The actual loss is still the same, but I'm just able to put less margin here for the same position size overall. Leverage for me is just purely a tool just to be able to put less margin to meet the position size. It's not by any means an actual way of getting a big strategy to create successive wins. It's just another tool to use in a safe manner. Now I'm going to actually plug in the details here. So let's put 16,650, and for the stop loss, let's put 16,850. And this section here, you can literally click any of these. You can order based on quantity, order based by cost, order by actual value. Order by quantity means it's more denominated in Bitcoin terms, but order by value I use for actual USDT value. So I click that. So if I put 20,000 here, I put 10x leverage, as you can see, and always check the section isolated as well. So I put 20,000. So if I lost this trade, I would lose $240. Just playing around with the numbers until it fits. So in this case, if the order value is 23,400, I would lose, as you can see here, $281. And that is around 1% of my account. So that fits my criteria. So that's it. I've typed it in. And what I do like about Bybit is that it has this risk management calculator, but it also shows the section here of the amount you're going to lose per trade. So it just comes down to having a rough idea of the value of a trade and just playing around with this box until the risk per trade just meets your criteria, really. And then I would press open short, and it shows you all the details. It shows your order price, the quantity of Bitcoin, the actual order cost, because this is the actual margin after putting 10x leverage in my case, and this is the actual total order value, 23,393, and this is the liquidation price. I honestly just use stop losses. Some people don't put a stop loss, and they just hold it hoping the liquidation price does not get hit. But personally, I've tried that but when I started, but I made huge blunders. I've been trading now for 10 years, and honestly, it's better just to put stop losses and just manage your risk and move forward. I always think there's always a trade for another day, and I'm trying to stand the test of time. And you just click that, you press confirm, and that's it. And it goes to the active section here. As you can see, it shows the trade here. Another thing is, before the trades, I always put post only, and that actually saves money as well. The next question people ask is, do I press limit order or do I put market order? And it really depends on your trading style. For example, if you're the kind of person that scalps and you're using indicators to actually get precise entries, it would make sense in some way to use market orders. And in market orders, as soon as you click the button, the trade is opened. So your trade is entered based on market conditions. but the only issue is that you'd have to pay more expensive fees. Me personally, because I'm using the 4-hour, 1-hour, and 15-minute time frame, I use limit orders. Limit orders, your order isn't filled in market conditions, so it's not filled immediately, but it's filled based on the actual orders in the order books. So you're actually providing liquidity to the market in some sense, so you're actually not paying as expensive fees. There's also something called conditional orders, and this is similar to limit order, but the only difference is that there's a trigger price. Conditional orders aren't as commonly used, but it is common, especially for breakout traders. And going back to this chart as an example, so say you think, okay, price is here, I don't want to open a long position here, but once price breaks a certain level, so for example 16.1k, I want a long position to be initiated. So the way you would do it then is you put 16.1k as the trigger price here, and then you might decide, okay, I then want my actual entry to be 16,140. So you put that here, and then you just put the stop loss as you would in a limit order. I personally don't use it as much because sometimes there is something called false breaks, in which sometimes there's a false break and the price just comes back down. But this is another tool which some people do use and some people do find value in it. And I talked about funding rate here as well. So in this case, the funding rate is negative. So that means speculators are bearish. So people who are opening short positions will be paying a premium to people who are opening long positions. So in this case, if I open a short position on a limit order, I might have to pay a bit more fees to people who are opening long positions. But on the other hand, if I was opening a long position and my analysis suggested that the long position was the right play, then in the case of this negative funding rate, if I opened a long position, then I would actually be paid a premium for opening that position and keeping it open from people who are short, as long as the funding rate is negative. So I'm just going to open an actual market order just to show an example. So say, for example, I put the stop loss at 16,500 in the sake of this example. So in this case, I've increased the value of the trade to 46,000 and using 10x leverage. And if I lost this trade, it'd be $281. I'm just placing this trade as an example to highlight the point of a market order. So I'm opening short, and as you can see, liquidation price 17.9k, quantity 2.8 Bitcoin, and it's happening immediately. So I'm pressing confirm. So as you can see, I've opened this short position in real time and it filled almost immediately. So I've also already had some fees taken out purely because it's a market order. And so I've had to pay this premium for opening it in real time. This is the unrealized profit and loss. This is the amount that I've already lost. This is my stop loss. This highlights my liquidation price. This is my margin, position margin. This is the current price. This is my entry price. This is the quantity of Bitcoin. This is the total value of Bitcoin in the trade in USDT value, and it equals your position margin times your leverage. So in this case, the leverage here is 10x. And so this value equals position margin times 10. And it's interesting if you go up here and if you change the leverage. So if I change the leverage to 5, and if you go down and look, as you can see, the quantity for the trade is still the same. The actual value in USDT is still the same. All this is still the same. But the liquidation price now is at a slightly lower level, and the actual position margin now has increased, because before I was using 10x leverage, and so my position margin was half this, but now because I'm using 5x leverage, my position margin now is double the amount, which makes sense. And this shows how much I'm up. So I'm up $110 so far in this trade. This is just to highlight the principle that leverage is just a tool, and it's just a tool for you to decrease the amount of margin needed for you to meet the position size needed to actually put up the trade. Leverage is very dangerous and it has to be used in a sensible way. Something else to consider is the different contracts you can trade. And so far I'm using USDT perpetual. So what that means is I'm trading based on the denomination of USDT. And you can do that for several pairs. For example, BT USDT, ETH USDT, SAND USDT. And so many pairs have been put up on Bybit, and this is one of the reasons why I do like Bybit as well. Another option is USDC Perpetual. So in this case, you're using USDC as the collateral. Inverse contracts means you're actually using the underlying cryptocurrency as the collateral. So for example, instead of trading with USDT as the collateral, your actual trading style is by trading and winning, you're trying to accumulate as many units of the underlying cryptocurrency as well. In bear markets, people don't generally tend to do this as much. So say, for example, if you believe that a cryptocurrency like Bitcoin or Ethereum will go up in the future, and you want to focus on accumulating as many units of it, you might decide, okay, now I might set aside some portion of my portfolio to trade with those cryptocurrencies as the denominator, and I'm going to focus on winning trades and accumulating lots of units of those trades. So that's what inverse contracts are for. There's also inverse futures, but that's not very commonly used, and that's similar to the equities futures, but the only thing is that it has expiry dates. And to be honest, most people that I know just use USDT Perpetual. This is the most commonly used, and some people use inverse contracts as well. But guys, it's just to highlight that this has to be used sensibly, and I do believe that trading has to be treated like a profession. And you need to realize the concept of leverage and risk management. And sometimes people say, oh, leverage is a bad thing, it should not be used. But you need to take everything in context, as I've shown by this video. If somebody is using 10x leverage in a sensible way, but only risking a small portion of their account, for example 1 to 2% of their account. So in other words, they have 50 to 100 attempts before they blow up their account. But someone else is using 2x leverage, but risking 40% of their account on their trade. Then the person using 2x leverage is a less safe trader, because the person who's using 2x leverage but risking 40% of their account per trade means that it would take that person 2 or 3, 4 attempts before they actually blow up their account. And so you need to realize the relationship. And I just hope by this video, and you just playing around with the tools that I've highlighted in this video, you really understand the concept of leverage, margin, and that you really understand how to use this platform in a safe way. I just recommended Bybit because that's what I've been using, but I think everyone should definitely do their own due diligence, especially given the recent FTX scandal. I also like Bybit because of the general customer service as well. And I like the chat function here, and I just wish that someone had made a video like this for me when I started. Guys, I hope this video has been useful. Do check out my YouTube channel. I set this up quite recently. I've been in the markets now for 10 years, and I'm really passionate about trading and helping people to speed up their learning curves. I post things like Bitcoin analysis, and also how to use various tools, for example Fibonacci, and other tips that really helped me. But thanks a lot guys for watching, and I'll catch you in a bit.